Welcome to Credit 101 from Adulting, a crash course. Let's get started by reviewing a few key terms. First, what is credit? Credit is when someone loans you something, usually money, and expects repayment. Next, what is a credit score? A credit score is a rating or grade that indicates the likelihood you will repay a loan. Now, collections. Collections happen when you miss multiple payments in a row, generally about 6 months worth, and then the lender sells that debt to a collection agency to gather it back. For example, if you took out a loan from a bank for $5,000 and don't make payments for 6 months, the bank can sell that debt to a collection agency for, let's say, $3,000. And that's when the horror stories start. The emails, phone calls, letters, anything they can do to get that debt back from you, because any dollar over $3,000 is profit to them. When it comes to your credit report, there are two types of pulls that can happen. The first is a soft credit pull, or sometimes called inquiry. This is when someone reviews part, but not all of your credit report. The good news is it does not have an impact on your score. In fact, you, as the individual, are able to look up your score as often as you want to keep tabs on it. The second is a hard credit pull or inquiry. This does take a few points off of your score, as the requester is reviewing the entirety of your credit report. You do have to offer consent because it does impact your score, but the good news is this is a very rare occurrence. It generally only happens when you're applying for a new loan or a new credit card. Next, let's talk about the credit score. The FICO score is used over 90% of the time when someone's making a decision about loaning you money. There are a few other types, but they're used so rarely and they're so close to the FICO score that this is really the most important one to focus on. As you can see, there are 5 components to a FICO score, but they're not weighted evenly. The largest and most important is payment history at 35%. It's critical that any credit card or loan you have, you make the payments as soon as they're due every single month. Next is amounts owed, and that's 30% of your score. Sometimes you'll see this referred to as credit utilization. The ideal threshold for credit utilization or amounts owed is 30% of what you're allowed. So let's say, for example, you have 2 credit cards that each have a $500 limit. So in total, you can charge up to $1,000. Ideally, for your credit score, you're only going to charge 30% to those credit cards, or a total of $300. I know it's not ideal. You're excited to get a credit card with the high limit. But again, to keep your credit score in good standing and continue to build good credit, it's really ideal to keep your expenses and your charges to any debt, especially credit cards, below that 30% level. Next is length of credit history, which is worth 15% of the score. If you don't have a credit card now, I recommend getting one if you can be responsible with it. The sooner you get one, the sooner you're going to have history. Also, whatever card you get first, continue to use that card for as long as possible and keep it open and active. That's really going to help your credit score. Next is credit mix at 10%. This one isn't as important, but eventually you'll want to have different types of debt that you can manage. Things like credit cards, and whether it be a student loan, a mortgage for a house, an auto loan. It shows the lender that you're not only good at paying back debt, but different types of debt as well. And finally, new credit at 10%. Ideally, you're going to wait at least 6 months between opening different types of credit. As you can imagine, if I were a bank and you're asking me for money, and I see that you've asked 3 other banks for money in the last few months, I'm going to be hesitant to give you more. I know that you have to repay them, and I don't know how likely you are to do that, and I don't really have enough history to make a decision. That's why new credit is incorporated into the credit score and is worth about 10%. We've talked a lot about the credit score. So, what exactly do these numbers look like? Again, I like to think of it like a grade. So, anything over 720 points is an A, and you can generally get lending pretty easily and at a pretty good interest rate. 690 to 719 is good or kind of a B. It's not bad. You can still get a loan most of the time, but you might be paying a little bit more in interest. 630 to 689 is fair, which is a C. This is where lending can get tricky, and some lenders might turn you away. And if they don't, they're going to charge you a lot of money in interest. And finally, 300 to 629, kind of skipping over D and going to F. It's very rare that you can get a loan at this rate, at this score. And if you do, it's going to be very expensive. So in summary, the higher the score, the lower the interest rate will be, ultimately saving you money. For example, if a person with a score of 720 asks for a loan for $1,000, they might pay 5% to borrow that money, which means they ultimately pay the bank $1,050. However, if someone with a score of 689 asks for a $1,000 loan, their interest rate could be 15%, which means they ultimately pay $1,150 for that loan. Essentially, the bank will charge you more if you have a higher score. That's it for this lesson on credit. I encourage you to check out our next video, Credit 201.